In this next episode, let's talk about the golden rule of 5 to 10% in 50 Shades of Money. As we've discussed in previous episodes, if you lose 50% of your portfolio value, it's going to be very, very difficult to recover. I'll give you an example. Let's say you have $1 million, you enter retirement, and the market drops by 50% like it's done in the last 2 market crashes. How much rate of return do you actually need to get back to even? People might say, well, I need 50%. That's not true. 50% only gets you back to $750,000. In order to get back to even, you actually need a 100% rate of return, which is extremely difficult to do. Dan, based on that concept of losses, how should a retiree look at their portfolio and what should they consider in developing a properly planned retirement income plan?
Well, Jim, at Peak Financial, you and I have created what we call the golden rule of 5 to 10%. And it really means at retirement, you have to position your portfolio to make sure you have no larger losses than between 5 and 10%, because those types of losses can potentially be made up much easier than larger losses. As you discussed, if you suffer a 50% portfolio loss, which has happened twice in the last 15 years, you have to make 100% to get back up to even. I don't want to have to look at a client across the desk and say, yes, it's easy to make up 100%. Do you?
No, not at all.
That's like the worst feeling. So we want to be able to look across the desk and say, we don't have to make that much up if we do have a severe market crash. So let's look at that example. If you have that $1 million, you lose 50%, it goes down to $500,000. You make a 100% rate of return, you're back up to $1 million, and you don't make any gain. So we want to avoid that. Well, people say, well, what if I just suffer a 40% loss? If you just suffer a 40% loss, your $1 million goes down to $600,000. How much does $600,000 have to earn? People say, well, 40%. No, it has to earn 67% for that $400,000 to be able to go back up to even. And then people say, well, what about a 30% loss? A 30% loss on $1 million goes down to $700,000. We still got to earn 42% to get back up to even. And then they say, well, what about a 20% loss? That can't be that bad, Jim. That's what a bear market is. They call it a bear market 20%. So if you lose 20%, you still have to earn 25% just to get back up to even. How does that math work? You have $1 million, you lose 20%, it goes down to $800,000. If $800,000 earns 20%, that's only $160,000, you're not even. $800,000 has to earn 25%, which is $200,000, just to get us back to even. So do you really want to have to earn between 25 and 100% to get back up to even?
You don't. And what retirees have to understand is that they can put specific rules in place in their portfolio so they don't have to go through this. You can't rely on a third party that has not put things in writing for you. You have to have it diligently put in writing for you so you can actually see these numbers that Dan and I are talking about and know that you have a predictable course to retirement success.
Now, if you can limit your losses to between 5 and 10%, we really get into the playing field of what we call safety. That's called the safety zone. If you lose 10%, in your portfolio, you only have to earn 11% to get back up to even. That's doable. If you lose 9%, you only have to earn 9.9% to get back up to even. 8%, you have to earn about 8.7%, 7%, about 7.5%. If you lose 6%, you only got to earn 6.4%, and that's not that hard to do. If you only lose 5%, we only have to earn 5.3% to get back up to even. Now, we can look across the desk at you and say, if we lose between 5 and 10%, we feel confident over a short time period we can make those types of losses up. If you lose between 20 and 50%, we don't feel confident in telling you you can make those types of losses up.
And the key is that you can design a portfolio that does exactly what we just talked about today in 50 Shades of Money.
So the overall goal is a must. You have to design a portfolio. You have to work with a team that can create that type of 5 to 10% maximum loss in a worst case scenario, meaning if the market goes down 50%, you want to be in a 5 to 10% risk factor. Think of what that would feel like. Everyone else has lost 50%. Your best friends lost 50%. Your family members have lost 50%. You've only lost between 5 and 10%. How would that feel knowing you're protected? You have to design that type of program. You have to work with that type of team to make sure you're safe all the way through your retirement.
If you like this video and want to create your own retirement income plan, we've just created a brand new video that will walk you through this process. All you need to do is click the link below and we'll send that video to you.